Welcome to the Glass is Half Full talk show. Let's face it, life can be tough in many ways. Here on the Glass is Half Full, we focus on how life is tough financially. Dealing with these financial realities can be a challenge. Essentially, we have to find ways to do more with less. Less money, that is. The show is focused on helping you discover ways to achieve that goal, even if you don't have a lot of money to work with. We'll be meeting people from many different walks of life. They'll share their stories and expertise. Looking to do more with less and maintain a positive attitude while you're doing it? Welcome to the Glass is Half Full. Now let's join Richard and his guests in the studio.
Now, there's always a further protection that goes into these things. It's called mortgage insurance. Mm-hmm. I know when you're dealing with a bank, they're very, very prompt to want to line up mortgage insurance.
Absolutely.
Now, this isn't insurance for you, is it?
Well, this is insurance for the borrower, life insurance and/or disability.
When I said you, I meant the book.
Yes, it's insurance. Well, I mean, if one person, the estate, if the mortgage is paid off, if a person dies, let's say, mm-hmm. then the home goes to the estate free and clear.
Yeah, right. So it protects other people, but not the borrower.
Well, I mean, if let's say there's a husband and wife, mm-hmm. it might protect one of the borrowers.
But the main person that it protects is the lender.
It protects the lender.
Because the money, if I'm married, if I buy a house in my name.
Yes.
And call it $1 million house, and mm-hmm. I have a $500,000 mortgage on the thing.
Yes.
And then I die, and with insurance, with the mortgage insurance, the insurance company will write a check to whom?
Well, if you get regular life insurance, you name the beneficiary. So normally you name the beneficiary as somebody in your family. Mm-hmm.
But that's regular life insurance, right?
That's correct.
Is that what they mean by mortgage insurance?
Well, the banks sell mortgage insurance, and I believe that if somebody dies, that the money goes straight to pay off the insurance. Or if there's a claim, it goes to reduce the mortgage.
That's why they want the mortgage insurance, right?
That's that, and also because they like selling add-ons and extras, because you can make a lot of extra money selling different things.
But you cannot buy the insurance from the lending institution.
You don't have to buy insurance from anyone. Okay, it's a good idea to do so, because if you're thinking about if you have heirs, if you have mm-hmm. family, a spouse, and you're thinking about the spouse, and if something should happen to you, would you want your heirs to have to sell, or would you want them to be able to continue to live in the property? If you want them to be able to continue to live in the property, you think, how are they going to manage financially, assuming you're the breadwinner or the primary breadwinner? Mm-hmm. So your estate, your heirs will benefit by having insurance, and that's, I think, the main reason why people should get insurance.
Well, that speaks for insurance in general, right?
Yes.
It's always a good idea to have some protection against eventualities, right?
Right.
Yeah. We don't predict the future very well. As human beings, we're very, very poor at that.
Anything can happen in life.
But the whole idea of the concept, people hear about this business about mortgage insurance. Is it essentially an insurance where you're purchasing, in other words, it's costing you money, mm-hmm. but you're insuring the lender from loss if something happens to you?
Well, yes. So, I mean, listen, if you died, and you have a mortgage, it's not like the mortgage disappears, right? They'll still have a legitimate charge on the house. Because the question is how will they pay for it? If your income is gone, you may not be able to service the debts.
If you're gone, your income's usually going to be gone, right?
Right.
So that leaves the lender not getting paid.
That's correct. So whoever is managing the estate.
Is that why they insist on you having insurance?
Well, they don't insist.
They don't?
We have to offer people insurance, and they don't have to take it. We have to offer it to them, mm-hmm. because I've known there were cases before where, let's say, somebody bought a house, mm-hmm. and the minute you sign and you're your purchase is firm, like you've waived
Right.
all financing conditions or anything else. Let's say that house is closing in 60 days.
Right.
If you die between now and the closing, you still have to proceed with that contract. Like your estate
Your
takes
estate
it,
does,
right?
yeah,
So there was a case, from what I understand, where it was a husband and wife, and the husband died, and then the wife they didn't have insurance, and the wife was sued. Because she didn't close on the house, but she couldn't close, but she was sued. So that's why the minute you firm up your deal and you're dealing with your bank or your mortgage broker, you don't necessarily need to take the insurance from them, but it's a good time to be looking at insurance for your own benefit and for the benefit of your own heirs.
In the example that you just gave, the purchaser dies before the closing. The spouse, the beneficiary of the estate, okay, was then responsible, or the estate, because it's her, she's it basically. That estate is responsible for closing the sale.
That's right.
But the lender wasn't committed?
Well, the lender the lender can back out. See, because when we get people a mortgage approval, usually it's a conditional approval. And, like we'll submit an application and we'll say this person makes a certain amount of income. But the lender can get out of that deal up until like the day of closing. So a lot of times lenders are verifying
so they'll back up because now the
employment.
person doesn't have any income, he's dead.
Yeah, to verify the employment or something, they find out.
And yet she can't back out of the sale.
That's right.
So it's kind of a one-way street, right?
It's a one-way street. Yeah. Well, death is never a good. Usually not a good option.
No, you're right. Death is usually a one-way street too.
Yeah.
Okay. What a morbid subject to be
Hey,
talking
good
about.
news. This glass is half full here.
Let's stick on that particular philosophical plane. Okay, we'll keep it as half full. Okay, nobody dies. Okay.
Perfect.
I wanted to ask you though that even though nobody dies, unexpected things happen to people, negative things, sickness and so on and so forth, right? And these are the people we see, right? In the insolvency business, these are the people we see. But when somebody has some negative, unforeseen thing happen to them, can you, as a mortgage broker, help them through the use of their equity, whatever equity they may have in the thing, to help them get over rough patches, as we would call them, even though that might affect their credit rating?
Yeah, for sure. I mean, if there's equity in a home and people run into some kind of problem, and things do happen in life, they can access the equity in the home,
even if their credit rating has been adversely affected by what's going on, because people don't give up right away when they start having problems, right? They try to keep things afloat,
right?
But they can easily find themselves falling behind in payments and all that as they struggle to maybe take from Peter to pay Paul, and things like that, right? And so 6 months down the line, the problem hasn't gone away. They still have equity in the home, but now their credit rating has become besmirched, so to say. Okay?
Yes.
So you can still help them?
Yeah, well, so a lot of lenders want to see that there's a plan, right? So they're not, they wouldn't normally, let's say, just lend money and not consider the borrower's credit and what's going on, but they might look at it and say, well, look, you have $50,000, let's say, in credit card debt that you're having trouble paying. If we get you a mortgage, we can maybe reduce those payments. Some credit cards are 20-30%,
sure, yeah.
right? So a mortgage, I mean, in this case, if the person's without a job, let's say, they're not going to be getting money from A or B lender, but even if they're borrowing money 10 or 12%, it might help them to solve the problem, and then they can improve their credit. Hopefully they're going to be re-employed again soon.
It'll certainly be better than the 19 or 26% they're paying on their credit cards.
Exactly.
And they should be looking into that. See, this is one of the
Yes.
options we discuss with people when they come to see us. When people come to see us, we don't just talk about bankruptcies and proposals. We talk about consolidation loans. We talk about using resources that they have or might have available, might be accessible to them to try to avoid having to do the bankruptcy or proposal.
Yes, I think that people should start looking to have conversations with professionals like yourself and me before they start missing payments. Because as soon as they start missing payments, like we get people who come to us, they have all kinds of equity in their house. And we may have been able to get them, but if they miss payments and they let their credit go downhill, then when they come to us, we can still get them the loan, but it's going to, if the equity's there, but it's going to cost more money. It's just going to be more expensive if they've let their, so they should talk to people, professionals, before they start missing a lot of payments for some guidance.
Well, it's a message in our advertising. We try to get that across all the time.
Right.
Why wait till things have already gone downhill before getting advice?
Right.
And advice is easy to give, not so easy to take, I understand. But,
Apparently.
we have a number of people, this happens fairly frequently, they're insolvent, and that means that they can no longer keep all their creditors happy through their own resources. And so they do something with us, but most people don't want to do a bankruptcy. In fact, I think in the 30-some odd years that I've been in this business, I've never met anybody who wanted to do a bankruptcy.
Right.
I've met an awful lot of people that did because they had to, but they sure didn't want to. However, what we do, we provide an alternative to that. It's called a proposal or a consumer proposal, depending. Right. And they do a proposal, but they've got some equity in the home and so forth. So they're paying this proposal, and usually proposals are done over a 5-year period, a 60-month period. And they get maybe 2 years into it or 3 years into it or something. Okay, and it's like anything else. It's a negative drag on them.
Right.
Okay, it may have a positive end, but it's a payment that they have to make, right, and so forth. So we suggest to them, we very often suggest to them that they look at using the equity in their home to maybe pay off the proposal.
Right.
So even though they've done something under the Bankruptcy and Insolvency Act, okay, can you still help them with that?
Well, for sure, yeah. We do get people who are in a proposal alone, but the lenders will typically want to see the balance of the proposal being paid out in one shot from the loan proceeds. I think
that's a normal consolidation loan factor, isn't it? They don't want semi-payouts.
No,
they
because
want 100% payouts.
They want 100% payout because I think, correct me if I'm wrong, but let's say there's a $1,000 a month monthly payment on a proposal. If somebody was to make a lump sum payment, it's not going to reduce the $1,000 a month. No, it's not. So
well,
the only way,
I shouldn't say that. It prepays the proposal.
Right.
So they can reduce their payments if they're ahead, right?
Okay, all right, that's an interesting point. Well, generally speaking, though, the lenders, they want to see the proposal paid out in full from the proceeds. Now, but I think it's worth mentioning, though, that sometimes when people are looking to do a proposal, they can get a mortgage at the same time and do a lump sum
In other words, they can use the equity to use the proposal process, to fund the proposal process, to get out of debt.
Right, and then and rather than having payments over 5 years, they could do it in a one-time shot, and it's done.
And then amortize their payments over a longer stretch, and through the mortgage process and all that. Some of our viewers, hopefully not many, but some of our viewers might be people who have done a bankruptcy or a proposal. They've perhaps gone all the way through it, perhaps they're coming to the end of the process or something like that. And one of the things that's going to be uppermost in their minds is the regaining the good credit status that they used to have.
Yes.
Okay. Can you help them with that?
Yeah, well, there are some things that people should do, can do, to reestablish the credit. The first thing they can do is they can go and get a secured credit card. Home Trust is a company that offers it, and basically a secure credit card is you put down some money which they'll hold on to. So, you can put down $1,000 or $1,500. They'll hold the money, but they'll give you a credit card that you can start using. So it's convenient, and it's a way to start rebuilding your credit.
Does it operate just like a regular credit card?
It operates like a regular credit card, except they're holding on to some of your money.
Secure, yeah.
Which, and that's a good way to start. You can also go and get a car loan, because the car lending companies are pretty flexible. They'll charge you a higher rate on a car, but it's a good way to start to reestablish credit.
Right.
So you can start reestablishing your credit, and you can get a mortgage from a bank if you've had 2 full years of reestablished credit. So it's by no means game over if you declare bankruptcy or go for a proposal. You do get a second chance.
Is there a difference in your experience if people have done a bankruptcy or a proposal, or a difference in the speed with which they can recover their credit rating?
I haven't really noticed a difference. As from a lender's point of view, they look at the date of completion of a proposal. They want to see, like a Schedule A bank or an A lender, they want to see 2 years minimum reestablished credit, at least from my experience, that's what I've seen. Whether it's a proposal or a bankruptcy, 2 years from the date of discharge of the bankruptcy or successful completion of and it's very important that you make all of your payments on time in the proposal.
Right.
Right? We have lenders that will give you a mortgage loan, the B lenders, the alternative institutional lenders that we talked about earlier. They'll give you a mortgage the next day after a discharge of a bankruptcy or completion of a proposal. You'll need to have it, probably a minimum of 25% down. You need to have good provable income, but they'll do it even 1 day after the discharge. The one thing is that you may not ever be able to get a mortgage from an institution who was part of the loss. So if they lost money,
have you seen that? Yeah.
Yeah. So if you lost money with Bank of Montreal, you go to Royal Bank. If you lost money with both Royal Bank and Bank of Montreal, you go to TD. If you lost money from all of them, then you have a problem.
There's always credit unions.
There's lots of lenders out there.
Right.
So you take steps to reestablish your credit. You do get a second chance.
But this can happen immediately.
It can happen immediately. Not with a bank, but with our alternative lender. They'll charge a little bit higher rate, but if you're back in the saddle, you're making money, you can show you're making money, and you've got 25% down.
But it doesn't happen by itself. You have to be what they call proactive about it. You have to be the one to make it happen. In other words, you can't sit on the sidelines and expect your credit rating to come back automatically.
That's correct. You got to get out there. Whatever the situation was that led to the loss, hopefully, if it's something that's in your control, hopefully you've learned something from it. Sometimes it's a business loss. You've learned some valuable lessons. It took you a little while to get yourself set in the right direction. But
people that go through a process to deal with an insolvent situation, they're not terribly happy about it, and generally speaking, by the time they get through with it, they're pretty well resolved not to repeat this process ever. Now,
right.
It happens because can't foresee the future, but they're very, very well aware that they really don't want to go through this again.
Well, it's a second chance. It's glass half full, right? They've learned some lessons, and it's a renewal. I mean, to be basically let off the hook for getting into all that debt.
On that particular point, I was telling you earlier that when people come in to see us, if they have a home, the standard thing that comes out, it's the first thing they say to us is, "I don't want to lose my house." Now, what would you say to somebody like that at that point?
Well, if you decide to do a proposal or a bankruptcy, it doesn't mean you're going to lose your house. So you have to disclose in the case, I believe, because those are court ordered, right?
Yeah, you have to disclose.
So everything has to be disclosed. But I know that a good trustee like yourself, there's ways to to arrange things so that people don't have to, don't necessarily lose their house.
You see, we say good trustee. Yes, the idea of the bankruptcy is proposal, the insolvency process, the law, is to serve both. But you have two protagonists, right? You have the debtor and the creditors, and they're both supposed to get something out of this law. The debtor will get a fresh start and all the rest of that good stuff, but the lender is going to have to. Usually, the lender will. Have to resign himself to get what he can from the assets, et cetera, et cetera. But very often, if there's equity in the home and all that, we're interested, and so are the creditors. Creditors agree with this completely. That as long as they get the kind of money out of the situation that they were going to get if the house were sold, they don't mind if the people get to keep the house.
Right.
All the same to them.
They're not looking to put people out on the street. Right?
That's right. Another way of saying it is they're people too, I suppose. Right?
Yes.
Yeah. All that. Well, David, I appreciate you coming down, and I'm going to ask you one last question.
Sure.
That is, I guess people looking at you here and listening to you, what would you say to them in terms of why they should come and see you under whatever circumstances they're in?
Well, whatever the circumstances, it's important to talk to people who know their business. I've been in mortgages for a long time, and I deal with both prime borrowers, and actually more of my business is in the alternate space, dealing with people who are not getting what they want for any reason. And I've had a fair bit of experience dealing with people who have credit issues and who have debt issues, and they're
I have to tell you, David, I could tell that.
Yeah. Okay.
So it's quite obvious you know what you're talking about.
So that's good. Thank you. I appreciate that. So don't be afraid to pick up the phone and give me a call, because you just never know. And
it's a no-lose situation, isn't it?
It's a no-lose situation. There's no charge for advice, right? And I don't charge for legal. It's not legal advice.
Not even, right?
Right. We don't get paid unless we arrange a mortgage. But that's the nature of our business. Is we want to help people, and they can pick up the phone and definitely tell them what we know.
I've had this sitting on the table. I've written this book, and the program itself is called after the title of this book. Its intention, well, I suppose there are many different little intentions, but one of the main reasons why the book got produced was because there's a number of people I've seen go through the bankruptcy, the insolvency process, and let it get them down, let it diminish them in some way. And I feel very strongly that the process should really have a different outcome, a little ultimate result. And when people deal with us, is we try to get at that, make sure that they can see the process that we're going to apply, which is a problem-solving process. They can see that it gives them an opportunity to make life better.
Absolutely.
But you can't get there unless you have the right attitude.
That's right.
And so we called it this, the glass half full, just to denote that attitude is a huge part of really accomplishing anything in life, right?
Absolutely.
So what you would say is that maybe these words have a lot of impact on your business too?
That's, every day that's the way you have to choose. You make a choice how you see things that come your way, their problems or their opportunities. So yeah, I think it's a great approach, and I think you have a great show, and I appreciate you inviting me to be on it.
Well, I'm very glad. Pleasure to have you. Glad you came and all that, and because you said such nice things about the book, David, you can have one.
Well, thank you very much. Will you sign it for me?
I'll leave it signed, yes.
Okay, amazing.
Thanks a lot, David.
Thanks a lot, Richard.
You're welcome.